Hello and welcome to our educational webinar about inflation, central banks, and next big market move. The sponsor of this webinar is YWO, one of the best trading brokers, and I hope you can join this broker and enjoy the opportunities we have there. Today, we are talking about the inflation central banks. The main reason actually for this topic is because, as you know, the last week, the most important central banks, they had a meeting, and it's very important to know how the central bank's making a decision when it comes to the inflation. The central banks, they have two very important mandates, which is controlling the prices or controlling inflation by somehow. Another one is to prepare the strong labor market, or better to say, the controlling the labor market as well. The controlling the labor market, the maximum to bring the labor market with maximum opportunities, and also the inflation to have the stable price movement. The stable price movement is different with the low prices. Those are two different. I'll talk about them. Since covering both these mandate in one webinar, it takes much more longer time. In different webinar, we will talk about the labor market and the central banks. But in this webinar, we're going to talk about the inflation, central banks. It is very important to understand uh, the decisions that they are making, the central banks making, the process of making this decision, and the condition that we have in the market, and the condition that we have that we may have after these decisions. Usually, what I was telling traders to try not to trade during the market, during the day that the central banks, they have a decision. So let the decision happen. And an hour after the decision is published, and we have the decision, we have the statement, and after that, you can open your new position. But if you have the position before that, make sure you read enough about the previews of the central banks and the possible effects, so you can understand whether you should keep your position, if it's most probably in a trend, you are in the same trend with the market or not, and get more information about the trades that you have and about the possible central bank decision, and also about the possible effects of those decisions. In this webinar, we're going to review the recently made decision by the central banks. What was the decision? What was the inflation before their decision, and what happened after the decision? Then we can check about the macro environment during those stuff, and also central banks' policies. We will talk about the policies that the central banks have, and also at the current situation, since we have the war and we have the high level of the geopolitical tensions in the market, we're going to check the energy shock and the commodities that they are changing the prices in the market, and also the scenarios, and also we'll check the scenarios, outlook, and live market charts. We will see how this decision made a difference in the charts before and after their central bank's decision. So let's start with the macro environment and see how was the economy grow and has the central bank's decision. Today I brought here the global economy grow, Euro area, Canada, Japan as some inflation, but still we have Bank of England and also Federal Reserve that they had a decision. Just like there are some example to understanding of what's going on. The thing is that right now we have generally the global economy growth is around 3%. What's up? Just like the market is thinking about that. And also the thing is that while generally the market is expecting to see the 2026 global economy grow around the 3%, it was before war start. And with this war that we are having right now, with the current situation that right now we have, which is affected the central bank's decision, we will check now what we can expect from these central banks. Generally, the euro area is the weakest economic growth between the most important economies across the world, and the market is expecting to see less than 1% economic growth in the euro area For the Japan also, just like actually we can say the US has the biggest economic growth expectations after the Japan. The Japan's economic growth also is very low. That's why the reason that we have after this tensions that we have between the central bank and the Japanese new government, Mr. Keiichi's government, there are very tensions between them. Mr. Keiichi's came from the party that they think that the Japanese economy needs more support, while the central bank's governor, Mr. Ueda, believes that the spread between the Japanese inflation, the Japanese central bank's rates, and European and also the American, especially central bank's rates, the spread that we have there is putting the pressure on the Japanese currency, yen, and that makes things to be imported more expensive, as the Japan, is one of the biggest energy importer in the world, as they have no energy sources mostly in the country and abroad, and they import the most of their energy resources from the and also the raw materials from other economies. So if you have the lower yen, from just like weaker yen, it means that your import is going to be more expensive. That expensive import brought the production price higher. You make the production price higher, and then you have the production price higher. It means that you have higher prices. Higher prices means higher inflation. So that's why there is a kind of the conflict between the central banks, Governor Mr. Ueda and Mr. Keiichi, the new prime minister, the first lady prime minister in Japan, in the history of Japan, that she believes Japanese economy is still struggling, especially after the COVID-19, and they couldn't still just like the cover 100% as they want, even though the Nikkei 2025 had the new record highs all the past weeks, and especially after the current market condition that they have very amazing earnings, they have amazing stock market as well as the Nikkei 2025, mostly based on tech and also the AI based companies and stocks. The most important central banks that they had a meeting last week, it was the Federal Reserve, United States. They held the rates between 3.50 and 3.75%, which was widely expected. Bank of England held the rates at, there's a mistake here. The Bank of England held the rates at 3.75%. There's just like miswriting. Just rated at 3.75%. Sorry, the same as the United States. And they held the interest rate at the April meeting, and ECB also held the deposit rate at 2% as it was expected, while the Bank of Canada held the rates at 2.25% and Bank of Japan at 0.75%. That was the miswrite, which is like it's supposed to be 3.75%. Just ignore this number. Anyhow, the reason because of that. What was the behind of this decision and the inflation? We know that the U.S. inflation, starting with the United States, the U.S. inflation we know was falling down towards 2%. Then we added to it, just like let me open that, let me share you another chart with you to understand this decision and the central bank decision, and also the inflation and how they can affect each other, the expectations that we have from the central banks. The Federal Reserve is very important to understand, and then based on the Federal Reserve, we can go forward and check the other economies as well. So let me share this. Here I can share this other. Share something else. Let me. There is a go. Okay. So here is FedWatch tools. What's the FedWatch tools? CME Group. If you go to the CME Group website, in a CME Group website, we have this FedWatch tools. The FedWatch tools. What's the FedWatch tools? It's the tools that shows what we can expect from the Federal Reserve's meeting, the next meeting that we have. And how those, and we will see how this, what's the difference, what's the relation between the inflation and this chart and financial market. Like, let's say, now actually this is because after the meeting, before the meeting, now we had more than same as now we have 94% chance for holding the current rate. Before the meeting, for the April meeting, the chance was more than 98% chance for the holding the rate, and the market held the rate. But this chart is the change that we had after Iran war, after the war, that the currently geopolitical tensions, because it's very important about the inflation. But after, before that, market was expecting to see the first rate cut in June. I mean, then in June or July. June is the next Federal Reserve meeting, and after like 42 days, after almost 40 days, that we have the next Federal Reserve meeting. Before the war starts, the thing is that market was expecting around like 45% chance for the rate cut. It means before market was expecting, now we have 5.4% chance. That was the chance of 48%. The 45% chance, so 43%, and 45% chance we had for rate cuts. Now we have 5.4%. The result of this is the inflation. Why? Because before the war started, the United States inflation was around 2.2%. The prices were down, and the market was expecting to see the lower prices. Average income was around 0.3% monthly base, annually 3 point average income for the laborers. It was 3.8, 3.9, 3.7%, which means that was bringing this idea that the prices are under control. So the market was counting on a rate cut to support the economy. Why the rate cut means supporting the economy? Because when you have the lower rates in the central banks, it means that when you're going to the bank and taking the loan, you have to pay less rate to the bank. I mean, the less is back to the bank. When you have the, I mean, for example, if you have $100 loan and you want to pay back the bank, if you have 5% as an interest rate, you have to pay $105. But if you have 2% as interest rate, you have to pay $102 back. It's a very simple example, actually. It's not calculating in this way, but it just like generally sounds like in this way. So when you have the less interest rate, it means that the businesses and the people, and mostly businesses, they will be able to receive the loan. They will be able to get the check, get the loan, invest in their businesses, which means supporting the businesses with more cash. So when you have the more cash, you can invest in different areas in your business. You can open the new shops, new offices, new branches, new production line, whatever you want. Why? Because you have cheaper money. But when you have the interest rates higher, there are less companies and less businesses that are interested to go after the new loan and new investment in the businesses. That's what when the central banks, they want to somehow to control the speed or the pace of economic growth, they increase or they decrease the interest rates. So with increasing the interest rates, you can slower the economic growth. With decreasing the interest rate, you can speed the economic growth, make it faster to grow faster. So but at the same time, when you have the money, more money in the market, your easy money in the market, when you have the more cash in the market, so there are the opportunity of the people, they have the more money, so they can go buy more, they are spending more. When you are spending more, it means that demand is more. When you have a more demand in the market, you have more money to spend, it means that you have a more demand to buy the more products and the services. So it means that the demand is higher, and when the demand is higher, prices are going higher. So lower interest rates will support the businesses, but at the same time, it can increase the opportunity of the cheaper money in the market. So when you have the cheaper money in the market, it means that you have more demand, and when you have a more demand, the prices are going up. So lowering interest rates support the economic growth, but at the same time, it can support, or it can cause the higher prices or higher inflation. So that's why when the inflation is low, the central banks will have a room or opportunity to increase the economic growth speed with the lowering the interest rate. So they will not be worried too much about the rates, about the prices getting higher and inflation. Before this situation, the current situation, the inflation in the United States was around 2.2%, and market was expecting to see the inflation by end of this year around 2%, which means that the central bank had room, the United States Central Bank or the Federal Reserve had this opportunity to go forward and cut the rates to give them more cash in the market and not be too much worried about the prices. That's why we had a more chance here. So while the Federal Reserve could cut the rates at the same time, it could be commitment to one of its main majority, which is the controlling the prices. But what happened after the war? When the war started, the oil price went higher, insurance prices went higher, we had higher shipment prices, we have actually now higher shipment prices, and all these causes the higher production price. Higher production price means two things. Whether this means as a product producer, if you have something product, something that you created with the higher prices. Let's say you have this phone with the higher prices. What happened when you're producing the phone with the higher prices? It means that you have to sell the phone also with more expensive prices or with higher prices. Whether you don't increase the final price for the customer and you cut from your profit. So in both way, it will lower the economic growth. Because when you have higher prices, there are less people to go out and buy your phone. Or when you have if you don't pass the production prices to your final customer, it means as a producer, you have a less profit. So this less profit means the less economic growth. Generally, when you have higher prices or higher inflation, it means that and you have the higher rates, it means that your economic growth is getting slower. So the central bank was going to decide. Before the decision, we had the war started, and also we had a month after the war, we had this central bank meeting. The war started, the oil price, the generally energy price in one hand, and many other just like first material prices that come, especially first material that are depend on the petroleum industry that comes from Persian Gulf, comes from the Middle East, and those Arabic countries around the Persian Gulf, like Qatar, Oman, Saudi Arabia, United Arab Emirates, or Iraq. All the prices that's coming out from there now, whether we don't have it, just like because the Strait of Hormuz is closed, so whether we don't have those stuffs to come out, if they come out with the higher shipment prices, with the higher insurance prices, generally the prices are high. So these higher prices brought this concern that maybe the inflation can go forward and can increase. That's why this care or the concern of the higher prices and the higher inflation put the central bank in a more defensive situation. That's why the Federal Reserve or Central Bank in the United States, they held the rate at 3.50 and 3.75% that it was before. And now for the June meeting, also, this is the opportunity, there's a less opportunity to cut the rate. Even though right now for the July meeting also, there are more than 90, with the current situation, there is more than 92% chance for holding the current rates. However, the market right now counting on the opportunity of higher, just like ending this tensions, just like earlier. That's why if you go further, you can see if you like look at the 25 basis point rate cut chance for this September is about 7.6%, but for the next meeting is around 5.4%. So that's what that means. That means that the central bank's decisions, the one of those numbers that the central bank's making a decision based on them is the inflation prices. We had other central banks as well last week, like we had European Central Bank and also Bank of England. Bank of England, let's go to the Bank of England. Bank of England on Thursday, they had a meeting. The Bank of England also held the interest rate at 3.75%. What does mean holding the interest rate unchanged at 3.75%? It means that what's happening in United Kingdom. United Kingdom inflation in United Kingdom also was just lowering towards 2%, like 2.3, 2.4%. But again, after the war, the energy prices also increased in United Kingdom as well, across England. And the Central Bank of United Kingdom, or Bank of England also, they decided to hold the rates unchanged at 3.75%. Why? Because the inflation and because the prices are going up. That's what you could see. You saw the prices unchanged at the same level. So that's why you can see that the inflation is one of the main and the key reasons to make a decision. Why I'm telling that? Because before the war started, before we have this inflation concerns, economic growth had various is actually still is suffering too much in United Kingdom. We have PMI numbers lower, around 50 the expansion area, which means that the UK economy moving much less than expected, which means that the British economy is under pressure. And when you have the economy under pressure, it means that you have to cut the rates, slower the rates, bring the cheaper money more in the market, and to when you have the cheaper money in the market, you can let the companies to go get in the bank and to go to the bank and get the loans and invest in their businesses. And in this case, you can see higher economic growth. So, but when you have the prices higher, you can see that Central Bank in United Kingdom with the 8 members voting to holding the current rate, out of the 9 members, they hold the rate at the same level. The same situation happened in Eurozone as well. While how? Because the Eurozone also they hold their rates at 2% as it was expected. The situation is that the situation in the Eurozone also is the same as Federal Reserve, the same as the United Kingdom, same as United States. That's why they held the rates as also unchanged at 2% for the base interest rate. But when you are going to the other example I want to tell you is the Bank of Brazil. Why the Brazilian Central Bank, or BCB, here the Brazilian Central Bank, while the BCB cut the rates. When it comes to the interest rates and inflation, there should be the balance. In Brazil, we could see the interest rate at 14.75%. And if you go and check the historical rates in Brazil, you can see these rates under 10%. But now the interest rate is about 14.75% as a minimum rate, which means that you are way above your average, so far than your average. It means that you still have a room to cut the rates. Inflation is around 4%, which is supposed to be around 3.5%, not just like the inflation target in countries in Brazil is around the 3.5%, not 2% like United States or Eurozone or United Kingdom. So the interest rates high, inflation is close to the target, but still high. But you can, at the same time, you can see that while you have higher inflation in the market, and at the same time you have the like much more expensive money. When we are talking about the expensive money, it means that your interest rate is high, and if someone wants to get the money from the bank, they have to pay more, which means the expensive money. So when you have the expensive money there, when you have the inflation higher, that caused this issue to push the central banks to make some dovish decision. So the central bank in Brazil, after this situation, because of the higher inflation, they didn't cut the rate by 50 basis points. They cut the rate by 25 basis point lowering. Just they wanted to show the market that they are ready to take a step forward, cut the interest rate and support the economy. But at the same time, they don't cut too much as there is inflation concerns. Let's give you some other example with the other example of the inflation and the prices in the different markets. If we open this PDF file that we have, and we split the PDF file, we can go forward and check our data. Here is just like the relation between the inflation and the prices in other markets. The main reason when we are talking about the inflation or the prices, that's what we can say. We can say that different um, measures, can change the prices. Like it can be raw material, it can be interest rate, because it can increase the price as mentioned explained before. It can be energy prices, or it can be supporting transportation prices, or whatever it is. Now the current situation, the interest rate, the inflation is mostly depend to the oil and energy prices generally. Energy prices sound like oil, sounds like gas, sounds like any other stuff that they're making inflation. But most of them now is because of the oil. Oil and energy prices, usually it has more than 10% of the just like market cap of higher prices. This that means if you see anyhow when we are talking about the different scenarios, we will have we will have the scenarios later. Let me be talking about the scenarios a little bit later. But let me explain what when we have the higher prices or higher inflation, how that can affect the markets. So you have the higher inflation, which means central banks should take hawkish decision. It means they shouldn't cut the rates. When you have higher prices and you don't cut the rates, it means that the cheap money is less in the market. So you have a less cash in the market, more demand, and when you have the more demand and less supply, the price goes high. That's why when you have the higher interest rates, when you have the higher inflation, that depends, or after that you have a higher inflation, the central banks deciding to hold the rates higher or increase them in the rates. That means mentioning just like they are lowering the level of the cash liquidity in the market. So in this case, you have a less cash in the market, more demand for the cash. So the demand is more than the supply. That can increase the prices. That's why when you have the higher rates in the market, after that which comes usually after higher inflation, you can see that the value of your currencies is starting to increase. That sounds for euro, same for the US dollar, same for any other currency related to its central bank. When you have the higher prices and you can increase the rates, it means that if you take a loan, you have to pay more to the bank. Or if you give the loan, you have the right to take more money as the rates, right? So when you are talking about the bond market, what means bond? Bonds are the money that you are giving like a loan to the government. So when you have the money, when you are buying it just like paper, it means bonds. When you have them, it means that you're giving your money, your cash to the government, let the government to use that, but at the same time, you will get the like percentage of that. So when interest rates are increasing, it means that the rates and the profit that against this bonds that you are getting, it can also increase. So higher interest rate, higher inflation will put the central banks in a more hawkish position, and hawkish position will make the money more expensive. And when you have the more expensive money, the higher rates, and in this case, the government also will be under pressure to give you or to pay you back more for the money that they are taking from you, which calls bonds. So higher inflation, higher rates means higher bond yields. That's why when the central banks they increase the interest rate, you can see the higher bonds. So you have the bonds higher and now the currency expensive. What means that for the stock market means when you have the higher rates, as mentioned, the companies they will be able to get less money for development. Since they have the less money or less opportunity for the development, their profit also will get lower. When they have the lower rates and lower prices, they will have less profits, which means if the companies they have less profits, will it means that their price of their stock also will fall. So the higher interest rates will make the money more expensive. And when the money is more expensive, there are less companies will be able to receive the loan or expand their businesses. And when they have the less money to expand their businesses, they have less opportunities to give their business holders or shareholders here the lower the profit of the company will lower, and that can lower the equity or the stock prices as well. So energy prices higher, currencies more, and all of them will increase the less will lower the profit for the companies. And when you have the lower profit for the companies, the equities price also falling. About the commodities, when we're talking about the commodities are it's very like kind of the big market, and it's depend on that. Generally, higher inflation will make the commodities to get more expensive, and when you have the more expensive, it means that the prices that coming up is more expensive and more. Again, the inflation is higher. So when you have the higher inflation, generally it can increase the price of the commodities. But at the same time, when we are talking about the commodities, as mentioned, we have different commodities. The commodities like gold is a safe haven commodity. Safe haven commodity, what means safe haven? It means that when you have some volatility in the market, some uncertainty in the market, you want to get like to invest your money in something that you know it's always value. What's that? That's the gold. So that's why the gold becomes one of the most loved or most kind of we can say used safe havens. You know, the people they save your money with that. So, but at the same time, when you buy the gold, you don't get the monthly payments, right? You are just getting your gold, and if the price goes higher, you increase your investment will increase, and if the prices fall down, your investment will be lower. So the gold is depend when you buy the gold, so you don't get any yield, any fixed income. But if you want to take less risk in the market, you go and buy when the market is uncertainty and there is a big volatilities in the market. You go and buy the bonds from the government. Why? Because you know 100% that these bonds are supported by the government. It's behind is very strong, and you have a very strong background on that. At the same time, you know that per month you are getting some fixed income, like 2%, 4%, 3%, whatever it is. It's different based on this time period of the bonds that you are buying in the country that you're buying in. So when you have the higher rates, interest rates in the central bank, when you have uh, just like stronger currency, like your stronger US dollar, there are less people who will get just like interested to buy the gold. They say, "Well, let's take a less risk, and go and buy the bonds." we don't have to pay for just like covering, putting it somewhere, just like if you have it gold in the home, it's more just like dangerous holding this, taking the guarantee. So when you have a bond, there is just like a paper, you don't need any guarantee that your money and your access to the banks that you have. Anyhow, so when you have the higher rates in the market, the prices for just like the prices or this rates for the bonds market also increasing. So when you want to make less risk, what you do, you go and buy the bonds. So why? Because the gold doesn't pay you monthly or just like any EPS or any earning per just like holding that, but the gold will pay you. Which is like, but the bonds will pay you. The gold don't pay you, but the bonds will pay you. That's why when you have a high volatility in the market, high volatility in the market, and you have just like higher yields, usually in that case, the gold as a safe haven will get the suffer. That's why the commodity prices depend on this stuff. Looking at the market, when you have the markets here, and just like that's in this current situation, when we are talking about, we thought that in a different cycles, we cannot generally say that the stock markets are good or stock markets are bad. It is generally, yes, we can say based on the EPS, based on the revenues that the companies brings is different with what I'm talking about. To understand what's going on in the market, you have to understand just like if just like this cycling market, cycling stocks. The thing is that now, even though it's just like even those periods that the stock market's prices was falling at the very first days of the market, some of the stocks, the price of some of the stocks started increasing. Like what? Like energy related companies. Why? Because the tensions start, the energy related companies, they're selling more, they gain more. So the stock based just like energy backgrounds stocks, they were increasing. Same for the AI, because we had a very good news about the AI. And yeah, the energy market price increased. Bond yields also increased. Doesn't matter for the US dollar bond yields, the American bond yields, or the Japanese, generally the bond yields also increased, but the energy, mostly because of the energy. But what's the scenarios? Okay, now we have the concerns about the higher inflation, and this concerns about the higher inflation puts the central banks in a more cautious condition. But what's after that? If the tensions slow down and the oil and energy prices weakens, and then you can see lower prices in the market. And when you have the lower prices in the market, it means that the inflation is low. When the inflation is low, you can let the central bank to cut the rates, and just like after current situation that you're suffering, to prepare the cheaper money for them to invest more in their just like in their businesses. For now, the current and the baseline situation for the oil is around $110. If you have a situation the price fall under $100, then you can expect step by step that the central banks in their next meeting, especially the Bank of England, especially Central Bank of the United States, or Federal Reserve, especially BOG. Then, if you see these lower prices, you can just count on the central banks to lower the rates and change their interest rates as well. And also, if on the other hand, if the prices, if the situations change, but in the worst side, it means that if you have a higher tensions in the market, if you have higher tensions in the market, the prices will go up. When you have the higher prices, you will have the higher interest rates as well. So what's interesting, what's main thing that can takeaways here is that inflation data set the just like inflation data is like they set the stage. They will let the, I mean, everything is dependent. The central bank's decisions depend on the central bank. It's dependent on prices. Central banks are very cautious when things are coming about the prices because they prefer to make sure that the prices are low to make a decision than to guess. So when it comes about the inflation, usually the central banks they get much more cautious. And also, uh, markets will change, can change their idea about the inflation so hard, rapid, just like so sharply, right? If the if the war, for example, ends tomorrow, markets will put their inflation expectation much lower. If the war gets worse, the situation gets worse, they will put their inflation or energy, their price expectations higher. So the market can change rapidly, can change sharply. You have to follow the news and the changes there. Uh, it's like if you just like let's check the chart and then say it's like to see the changes that we had, and then we can take your questions if you have any. Let's go ahead and check the charts and see the chart prices, and then we can check after the central bank's meeting how the central bank's meeting they shape the market and what happens uh, after certain just like decisions and how these decisions can affect the market. Here we go. So this is the chart. Let me open the DXY chart. So this is the US dollar index. US dollar index, when we had a meeting, let me make it in 1 hour chart. Okay, when we had a meeting on April 28th. In April 28th, market decided, the central bank made the decision in United States. What was the decision? The decision was holding the current rate, but uh, what we understood is that in the statement, the central bank had more hawkish tone. When there is a hawkish tone, it means that the higher rates can stay a little bit longer. When you have the higher rates longer, it means that it's harder to receive the cheap money. So the money that you take from the banks, the loan, it's more expensive. You have to pay back more, and all this process will increase the interest, will increase the prices and inflation, which means the central bank, to avoid this situation, they need to be more stricter. And when there's a stricter, it means that the cheap money is ending in the market, they're expensive money. So when you have expensive money, it means that the prices just like cannot go further. But at the same time, when you have banks paying more, it means that the interest rate is higher. When interest is higher, you get the less loan, less cash in the market, more demand is more than the supply. So the dollar index increased. Same situation we have in Japanese yen. USD, if you check the USD JPY, USD JPY is one of the amazing, is one of the most amazing, I can say, example that we can bring. After the central bank meeting in Japan last week, the Japanese central bank decided to hold the rates, but they give a very clear signal about the possible rate hike in next meeting in June. What does it mean? It means that the hawkish decisions. It means that the hawkish tone in the market. And when you have the hawkish tone in the market, it means that the cheaper money period is ending. And when the cheaper money period is ending, it means that your price and your currencies gets more expensive, or when you have the higher rates. So that's why USD JPY fell sharply here, especially after the news of that the central bank or the government of China, the Japanese government may intervene in the market. So this is the process generally of inflation. This is the process that how the prices are moving the market and how these prices can shape the market and can affect the central bank's decision. And when you have the decision, hawkish or dovish, how can it affect the market? Let me take your question if you have any, and then we can end our session. If you have any questions, we'll be more than happy to get your questions. Is there any question? Okay, no question. Thank you for being with us. Make sure that to check our website, yw.com. Make sure that you can check our trading condition, symbols that we have. Hope we can help each other grow better in financial markets. Have a good day. Don't forget, we're going to have the webinars in all Mondays and Wednesdays, and all of them will be at 12 GMT, just like GMT time, whenever the vote that you have, you can join us and enjoy these webinars. Have a good time.